Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, October 2nd. You are tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to talk a little bit about keeping perspective. You know, short term we've got some weakness, but let's look at some weekly charts for perspective. We'll look at yields and energy, which are both rising. We'll look at the main market drags: finance, communications, housing. Then we're going to focus on the energy-related ETFs. I will go over the questions that I received last week and, of course, finish with stocks to watch. Keeping perspective with the major index ETFs. All right, so I'm going to show you some daily charts first, because then I'm going to go to the weekly charts to put the weakness we've seen in small caps and mid caps into perspective. Because if you look at SPY here, okay, it's been running higher here since April with a pretty steady advance. And we had a gap down last week, and then we've kind of been stalling the last 1, 2, 3, 4, 5, 6 days, basically, with some closes near the low and not able to get higher. But, you know, that's a short-term issue, and maybe we get a correction, and it'll be clear, I think, when I put this into perspective to see what we've seen since April. We've seen a pretty darn good advance that has entitled to a correction. All right, if we scroll down and we look at QQQ, we can see that it is the leader here because it did just hit a 52-week high intraday on Monday. But it has the ebb, which is a decline, and the flow, which is the advance, and it's been flowing and ebbing and flowing and ebbing, and it's currently in a flow. All right, but maybe it's time for an ebb or a pullback. And again, I'm going to show a weekly chart to put this into perspective, but you know, clearly the longer term trends are up. Now, here's where we've been seeing weakness in the market. We get to mid caps, all right, stalling out for a few weeks and then moving lower. So MDY here is below its 50-day EMA. And you can see relative to SPY, it's been underperforming pretty bad since July. So July, August, and September especially have been really weak months for MDY relative to SPY. And then we look at IJR here, and we can see what I was calling a bull flag, even in mid-September, never got the breakout, and we just continued lower. And I was watching these RSI moves. We went above 30, went above 30, and we went above 30. And, you know, 3 signals basically have not panned out. And so is that time to be concerned about the bigger trend? Well, before you make that kind of assessment, look at the weekly chart. Now, before doing that, I'll just point out that we need to get this break above 88 to reverse this decline that we're seeing in IJR. But, you know, this is no longer a bull flag. A bull flag should have ended here in this 88 area, and instead we got further weakness. So it's still a pullback within a bigger uptrend. It's just not a bull flag anymore. All right, these next charts go back 3 years to encompass a pretty extraordinary bull run. As you can see, SPY here, you know, went from 180 to 290, which is just a massive advance over a 3-year period. And we can see, you know, flat consolidation, a correction, a tight consolidation there in early 2017, a big consolidation at the beginning of 2018, and the breakout. And you can see from, you know, April here, this April low, we're up over 16% to the recent high. So you easily have a double-digit gain going from April to September. And we haven't had much of a pullback. We had a 3-week pullback here. So we could get a pullback. All right, I think timing pullbacks is incredibly difficult. It's much easier to identify the trend. But if I had to pick a pullback area, you know, you put your Fibonacci retracements on, and, you know, maybe we could pull back to that 280, 275 area, 38 to 50% retracement of this advance from April. Now, if we look at QQQ, we can see that the advance since April is 22%. And one more thing I'll point out here. You can see SPY here has the triangle. And then you can see QQQ just pretty much continued higher with that higher high there and higher low. So it was showing some relative strength earlier in the year already. But, QQQ's up 22% from that April low there, a big advance. So, if it had a normal pullback within an uptrend, it could come back to this broken resistance zone and retrace 50% of that advance. And it could still be normal. Now, the sky would definitely be falling and there would be a recession on the horizon if QQQ got back to the 170, 175 area. Of course, I'm being very sarcastic because it would still be a normal pullback. Another thing to show you how strong this uptrend in QQQ was, 5-period RSI, which I'm showing in the indicator window, did not dip below 30 in 2017 or in 2018. All right, and if you compare that to IJR and MDY, they had a few dips below 30. So RSI did not even become oversold. That's how mild the selling pressure has been in QQQ in 2017 and 2018. Now, if we look at mid caps, there we can see how drastic this decline is over the last few weeks. It barely shows up on this 3-year weekly chart. And you can see prior pullbacks, all right, they lasted anywhere from 6 to 8 weeks. This one was 4 weeks. Then you had the big triangle everywhere and then the breakout. But, this pullback is pretty minor at this stage. And you could come back to this 355 area even and still be a normal pullback within an uptrend. And I say, that's not a pullback, mate. Look at that. Now that's a pullback here. All right, that's a decent pullback, but this is just a minor blip, if you will. It's not a lot of selling pressure on the price chart there. And at the bottom, you can see those moves above 30 for RSI. So we haven't become oversold yet. And I usually use daily charts and RSI to time, but sometimes the pullbacks get deeper than we expect. It's not a science. There's a bit of art, quote unquote, involved here. And if we get a deeper pullback, then I would use the weekly RSI and look for a move above 30 as a potential mean reversion opportunity. Now, if we look at small caps here is IJR, and it's had the deepest pullback of the 4 that I just showed, because you can see it's basically gone from 90 to 85. We'll call that about a 5% pullback, and we're down over the last 5 weeks. But we can see we had about a 4-week pullback here. We had another 4 to 6 week pullback, 3 to 4 weeks back here. We had a long period of stalling, all right, and then a breakout. Oh my God, the breakout failed. Well, it wasn't that big of a deal. That's why I pay more attention to the higher high and ignore a failed breakout. You can see another pullback here. So at this point, it's a pullback. All right, and you can see RSI is nearing oversold. So, it's going deeper than I thought, deeper than I would have liked using the daily charts. But, putting it into perspective, it's still not that big of a deal. We don't see a major topping pattern. And when we get RSI below 30, then I'll be looking for an upturn and a mean reversion opportunity. Higher Treasury yields and rising energy prices could be weighing on the market. Now, as you know, I am very wary of making an inference, whereas, this is affecting that, all right? And sure, we can find a reason, but often that reason is not the real reason. Often we find out the real reason after the fact, and I'll get to that with finance in a little bit. But if you look at the 10-year Treasury yield, it's clearly moving higher, all right? You had the initial surge in July 2016, a pullback and a breakout there in the summer fall of 2017, new highs earlier this year, a consolidation and breaking out above 3%, which is 30 on the chart. Excuse me. So that clearly calls for higher Treasury yields, and that could have ramifications. But again, look at the price chart for the underlying. All right, right now, the most this tells us, or the most important thing this tells us, is that Treasury bonds are in a bear market. And if you look at the 30-year Treasury yield, you can see it is challenging the highs from 2015 there. All right, so this is some sort of a basing process, and a breakout there at 3.2% would be quite bullish. Now here's a chart I showed in Don't Ignore This Chart, the blog at Stock Charts in January of this year. And it is a big double bottom in the 10-year Treasury yield. All right, you can see the two lows in that 1.5% area. You had the initial bounce, the pullback, and then the first breakout that I showed you on the chart before. And look at that, we're breaking double bottom resistance above 3% here. So that targets a move to around 4.5%. And that could be keeping buyers on the sidelines. All right, I don't see a lot of selling pressure still in the market, but this could be affecting it. And again, I'm going to look at stocks for stocks. And I look at the stock market, I still see 52-week highs across the board, and I still view it as a correction within a bigger uptrend as far as small caps and mid caps are concerned. But Treasury yields are definitely on the rise, and I expect them to continue rising. And you can see the 2-year yield hit its highest level in 10 years. And we look at Treasury bond prices. This is the unadjusted TLT. You can see I put an underscore before the symbol, so that excludes the distributions, the payouts that are being paid, the dividend basically on the interest earned from these bonds. And I think this is a cleaner way to look at a Treasury bond chart or anything that has a high yield like utilities or REITs. Same with IEF, the 7 to 10-year Treasury bond. On the left there, you see I put that little underscore to get unadjusted prices. And this reflects kind of the spot price for the long-term Treasury bond. And it mirrors basically what's happening to the 30-year Treasury on this chart and the 10-year Treasury on the chart below here. So we can see here the breakdown, the bounce, and the breakdown in the latter part of 2017. And we just stalled for most of 2018, but now we're making another move lower. And you can see that is a 52-week low yesterday actually. So it looks like Treasury bonds are heading further down and Treasury yields are heading up. Related to rising Treasury yields possibly, but definitely the dollar is on the rise. Breakout, another breakout, a little pullback with a wedge and breaking out of that wedge. So I would expect the dollar to continue moving higher. So if you had a crystal ball and you knew that the dollar at some point in 2018 was going to be up 10%, what would be your forecast for oil? Well, I bet you most people would say, I would expect oil to go down because commodities go down when the dollar goes up. Well, if you had based your assessment just on the dollar, you would have been flat out wrong. But if you looked at the price chart for oil, you would have still been bullish because you can see you had the big breakout in 2017. We had a 2-week pullback and then a move to new highs, a 4-week pullback and a new high, a longer pullback, and now we're back above 75 and at new highs for oil. So oil is in a long-term uptrend, and it has moved quite a bit over the last 2 years. So I'm not an economist, and I don't want to get into the economics of it. But, if you're an institution and you're looking to buy stocks, you're going to be looking at rising oil prices. You're going to be looking at Treasury yields rising. And you can say, well, maybe I'm going to hold off or look at certain other groups that might benefit or avoid certain groups that might be detrimental as far as, that might have a negative, might be negatively affected by rising Treasury yields and or rising oil prices. Finance, housing, and communications are weighing on the market. I'm going to start off with a couple of perf charts, and these two perf charts go back 21 days, which is basically the month of September. And we can see that one sector is clearly down more than the others. Financials down almost 2%, XLF. And we can see technology's up a little bit, industrial strong, healthcare strong, and look at energy, leading sector in September. And then further on the downside, you can see communication services is down 0.5%, and that's been weighing. And that is because Facebook and Twitter just cannot seem to recover from those big gaps. But what's interesting, if you look at these small cap sectors, you can see that only one is up. So, sectors as far as sectors have not had an influence. It's basically the style that's influencing. In other words, even though the large cap sector is up, the small cap sector equivalent is down, except for, well, you can see finance, but except for utilities. You can see utilities are the only small cap sector that are up. And then we can see that consumer discretionary is down, finance. Look at technology, all right? Technology is even down, industrial is down, materials, even small cap energy is down. So small caps are really bearing the brunt of this selling pressure. So when we look at communication services, the new sector that accounts for around 10% of the S&P 500, it has not gotten off to a good start, all right? It started in June here. It moved up a little bit, but then got hit hard with this massive gap, and that was, of course, Facebook gapping down. I'll show Facebook in a minute. But we had a little counter trend bounce, and you can see that gap was never filled, and then we broke down again. And now we've got another bounce that I think is a counter trend bounce, because if you look at Facebook next, it looks broken. And so if we break down here, that could signal further weakness in communication services. And you can see Facebook is around 17.5% of the ETF. Google is the big one. Still watching Google closely. And then Twitter is around 2.27%. So when I sit down and I look at a chart, the first thing I ask is, what is the bigger trend? All right. Now, if you look at Facebook here, you can make an argument that the bigger trend is now down. And that is because the 50-day EMA has moved below the 200-day EMA. Price is below the 200-day EMA, and it's been below for over a month here. And then you had this big gap down and not much of a fill there. All right, you had a little oversold bounce, but then you kind of triangulated and broke down again. And now we've got a little bit of a bounce. It's not a picture-perfect flag, but it looks flaggish because you got this sharp decline. You got this rising bounce. Looks like a flag. It looks like we're breaking the flag line, and we're heading to test these March lows here in Facebook. So that could weigh on the communication services sector because Facebook is the second largest position. Now, Twitter, of course, is a pretty small position in this ETF, but still, you can see this is a broken chart as well. You had the big gap down, you had a feeble recovery, and you broke down again. So that 200-day is rolling over, the 200-day EMA. 50-day is on the verge of crossing below. Price is below both. So, Twitter, yeah, maybe you get a bounce, but, is this a stock you want to be owning or looking at? Well, no, because you can see it's below the summer lows and is clearly underperforming, so you would move on. And so this one is out of favor, I think. So Treasury yields broke out and hit new highs, and that should be positive for the finance sector. But instead, the finance sector did an about face, and it didn't just, pull back a little bit, say to this 28-25 area. No, it continued lower with a sharp move for like 6-7 days. And it's kind of at its moment of truth now because this is a support zone. But it's broken the Roth line, it's broken the wedge line, and this is like the last bastion of support. And so we break here. But when you look at finance, as I've said before, you've got 4 other sectors that look a lot better. All right, you have technology, you have healthcare, you have industrials, and you have consumer discretionary. All right, finance is like 5th at best on the list. So you would just be moving on from this sector and looking elsewhere. And those 4 that I listed are still holding up the market. They have yet to break down, and that's what's keeping the market afloat. I'm not going to pretend to know what is going on with banks, with brokers, all right, but I do know that they've been out of favor, brokers have, because look at that lower high in May, June, and they were already back to these spring lows here in July, all right, and tested them again in August and September and broke below these lows last week. So broker-dealers is one of the weakest out there. And you say, well, RSI is below 30 and it just moved above 30. It's a mean reversion opportunity. Well, I wouldn't look at this one for the simple reason that the bigger trend is down. And I only look for mean reversion opportunities, bullish mean reversion opportunities when the bigger trend is up. So the fact that this one has been trending down since March with lower lows and lower highs tells me to move on to look elsewhere. And then the housing ETF, the home construction ETF, ITB here, it broke down last week as well. And that is a 52-week low in the housing ETF. Maybe it's because of rising Treasury yields. I don't know, but I'm sure that's part of the equation there. It affected negatively housing stocks, and it's affecting finance stocks negatively. But clearly, you didn't need to know about Treasury yields rising, because when you look at this chart, it's just been working its way lower all year. It got hit, and whereas the broader market started turning up in April, May, June, this one didn't get above that April high and continued lower. So it's been out of favor for months. Now you say, how can you be bullish on the market when you just pointed out all this weakness? Well, remember, the market is, you have to take a look at the weight of the evidence. And I still see strength in healthcare, industrials, technology, and parts of the consumer discretionary sector. So, on balance, there's still more strength and weakness out there. But, clearly these pockets of weakness are a concern. At the very least, you stay away from them. So where do you focus? Well, with oil still strong, I'm going to focus on energy and look at some of these ETFs now. So we're going to start off with 3 different sector perspectives on energy. The top window shows the equal weight energy ETF, RYE. The bottom window shows the sector SPDR, XLE. And then the middle window shows small cap energy. And we can see that small cap energy is lagging, equal weight or large cap energy. And that is because if you look at this high back here in 2016, you can see XLE exceeded it, and you can see RYE exceeded it, but the small cap ETF did not get close. Now, all of them have been rising pretty much since August 2017 here, and then we had this correction from May, and we can see that small cap energy is not getting this upturn, whereas you see XLE got this upturn, as did RYE. So we're seeing more strength coming in the equal weight and the XLE, and that's probably where we want to be focused. So I'm going to look at XLE, XES, XOP, and FRAK next. So when we look at XLE, we can see a big surge in April, and then this long decline into September, and then look at that move in September with a break above this high, with a gap even, and a break above that channel line. So XLE is breaking out, and I would expect it to move to new highs. Now, I can see the argument here, the risk to reward is not good, but oftentimes that is the case. Unless you're mean reversion trading or playing, a bounce off support, your risk to reward ratio is not going to be that good. But I'm seeing some relative strength in energy in September in this breakout. And so I am liking XLE here and thinking it's going to move higher. So first is XES, Oil and Gas Equipment Services ETF, and it's been a pretty frustrating one because I admit, I was watching it here in June, I was watching it in July, and then when you had this plunge in August, I gave up, and you had another plunge there in September. But I'm coming back to XES because, we do have a higher low. We did hold above that April low, so we had the big 38% surge, a big decline, but now we're breaking out and we have a higher high. So I would expect XES to move higher. And if you do a measured move, you expect a similar 38% advance from the low here. A measured move would project a move up to the 2021 area for XES. Now next up we have XOP, which is stronger than XES because you can see that pullback there was not as deep. All right, we retraced 38 to 50% and then broke out here. So XLP is stronger than XES. Then we have FRAK, which is the unconventional oil and gas ETF from Van Eck. Now, the volume is too low maybe for trading or investing, but you can use it to gauge the group as a whole, and you can find the stocks that are in the ETF by going to the Van Eck website. But, it looks like it's in a choppy uptrend, and you had that pullback, and now we've got a breakout. So it looks like FRAK is back. Hey, that rhymes. FRAK is back. So next we got the AMJ, the MLP ETN, and it had a big move up from March to August, and then what looks like a correction. I pointed this out in the weekly market review and outlook that RSI was moving above 30, and we got the surge the last 2 days. So this one looks poised to break out and continue higher. So if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I do not take individual symbol requests, okay? The first question is, why do you prefer ETFs over the Dow Jones Index industry groups? So if you go to the symbol catalog and you search for the terms Dow and Jones and US, as I've done here, you can see all the Dow Jones industry groups that we have. And this is a great list of industry groups, but I don't use them because I cannot find the components and the weightings for these industry groups, and that's why I use ETFs. With ETFs, you can go to the provider website and you can find the holdings there by clicking. Here I am at the SPDR website, and I can see all the holdings, so I know what's driving that ETF. In addition, ETFs are tradable, and that is a major benefit as well. You mentioned a chart list with industry group ETFs arranged by sectors. Where can I find this? Stock Charts members can download my chart pack. If you go to the upper right of any web page, you can search, and I'm just going to search for chart pack, and you can see at the top is a support article that'll tell you all about the chart packs and how you can install them on your account. And this is the chart pack that has these ETFs organized for you, the Arthur Hills ETF Master Chart Pack. Treasury yields are rising, but the finance sector is taking a beating. What gives? I'm just going to show one finance-related chart. This is the king of finance, Goldman Sachs. All right, if Goldman Sachs cannot make money, I don't know how these other banks are going to make money. If you look at the chart of Goldman Sachs, it broke down here in April, May. It had a little bounce back to this breakout zone and is breaking down again. So that's a big part of weakness in the finance sector. Goldman Sachs cannot even stay up. So, I don't think this is related to interest rates. There's something else out there. Stocks to watch with a focus on the energy sector. All right, we'll start with Verizon here, part of the communication services sector. Got a nice breakout there in July, hit a new high, consolidating and looking like it wants to turn up off of the 50-day there. Now we move into energy. Here's Newfield Exploration. It's actually been trending higher since March because that pullback is a higher low, reversal at the 61.8% retracement, and a break above the 200-day. National Oil Well Vodafone hit a new high there in the summer, pulled back, and this looks like a big support zone, so watching for a bounce. One Oak had a breakout last in mid-September, actually, a little triangle and looking for another breakout. Occidental Petroleum hit a new high in the spring and then pulled back into August, September, but is getting a wedge breakout there, so looking strong. Phillips 66 is bouncing off support, and you can see those two oversold readings, and we had two oversold readings in June. So watch for a challenge up to resistance in this refining stock. Range Resources been trending higher since February, but now getting some break above that 200-day with the move above the wedge line there. And finally, Oracle perking up in software with that big surge, a consolidation, and a big breakout, starting to outperform again. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.